This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cash back on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 49. As always, joined by the three amigos. We got Rich Diaz at Acorn Macro Consulting and his home base in London, not London, Ontario, London. And Keith Dicker of IceCap Asset Management, everyone's favorite boomer. Welcome back to the show, gentlemen. What's shaking?
Not much. It's a sad day in England, or sad week, I should say. We're mourning the loss of our monarch. The lady who, if you're unaware, is on the $20 bill. And yeah, I think it's otherwise it's okay. Things are pretty normal. Took the tube. It's lovely.
You'll survive, eh? You'll get through this tough time.
Yeah, I think I'll get through. There's a bank holiday on Monday, which is nice. Had to rearrange some meetings.
Keith went to high school with her, didn't he?
Yeah. Otherwise, it's all right. Now King Charles III is our new king. So hopefully they don't put him on our money. And I'll just remind all our listeners that the last two King Charleses did not have such a great track record.
Charles.
The Charleses, the previous King Charles the First, I can't remember. King Charles the Second, I think, was killed in the War of Roses or something. Anyways, so it's interesting they took that name. Keith, what's going on your end?
Well, I did not know the Queen. I did not go to school with her. I did go to school with the Queen mom, but not her daughter. So that's, haha. No, I thought it was. We'll go into it, of course, but I thought this is one of the best weeks of the year for markets. We had the big CPI print on Tuesday, and everything just got slaughtered out there, except one market did pretty well. Rich, do you know which one?
Yeah, the dollar.
Yeah, here's the theme for the day: the
King dollar.
King dollar. To get it? Yeah, Steve?
Oh, that's right.
Yeah.
Oh, brother.
Okay, the Roman lover. What do you got for us, Steve?
Yeah, no, I'm on the last leg of my trip here, so you have to forgive me if it's internet. Yeah, I must say Italy really does have terrible internet. But man, the food and the wine is so cheap. Like I went out, you get like a full thing of like charcuterie. You go out and you buy like a wheel of cheese, fresh cut meat for like $10. It'd be like 50 at home. The fact that you can just like go and grab a beer on the street, walk around. I must say, like coming here and experiencing the cost of living and the culture, Canada kind of sucks.
You're a convert. We did it.
Yeah, you're like, wow. Like literally, like we went for breakfast this morning. Two people, we ate a lot of food. It was like 12 euros. I was like, this would have been like 60 in Vancouver. It's insane. I don't know how they make money, but like, anyways, and like, we're going through this process of like, we go to these wine shops and we're wine tasting and they're like, oh yeah, well, we can do free shipping if you're in the US. But they're like, oh, but if it's Canada, your duties are like obscene. So there's no duties, I guess, if you import wine from Italy to the US, but there's egregious duties where like it literally does not make economic sense to buy wine and ship it back. So I don't know. Again, another thing with our country is just, way too much taxes, stupid policies, expensive cheese.
So it sounds like
But I
I'm the only.
digress. So I'm coming
the
home
only-
regardless.
Well, I was just going to say, it sounds like I'm the only true Canadian left here now.
You may be.
Yeah, it might
Yeah,
be.
you may be.
I love how you guys are traveling all the time and stuff, and you're enjoying the world. Meantime, like a boomer doesn't leave 2 blocks from where he lives, and I'm
You should
pretty
try
That's
it.
the
happy.
millennial life.
You should try it.
I went into this city the other day. I had to go in to get a coffee, so that was a big trip. Come on, let's roll into this. Is a big week, guys. We have lots of stuff happening.
Local Tim Hortons. Yeah, we got a huge week here. I think this is going to be another barn burner of an episode. I mean, let's start things off here on the Canadian side of things, as we typically try to. So, the obvious one here was politic wise, as Pierre Poilievre is officially the new leader of the Conservative Party. So again, regardless of your political views, I think there's some important things to sort of raise up here. So I think it was just kind of a slam dunk. I think everybody kind of knew that, it was going to be a Poilievre government on the CPC side. But I think there's some important numbers here. Again, all politics aside, let's try to look at the things here objectively, because I think what matters here is, what does this mean for the future politics in Canada? So the Conservative Party leadership race was actually the biggest political fundraiser on record as per Elections Canada. So all the candidates combined raised a total of $8.3 million from 55,000 donors under the federal law that caps individual contributions at $1,600. And so apparently half of those were actually raised by Pierre Poilievre. So Pierre Poilievre reported $4.6 million in contributions from 39,000 contributors. It was the largest fundraiser by any candidate since Parliament passed the 1974 Election Expenses Act. And just for a little bit of context as well, Trudeau, in his successful 2013 campaign for the Liberal Party leadership, he raised $1.9 million from 11,000 donors. So, again, I know different times money was worth less in 2013, 1.9 million from 11,000 donors. I think what's more important here is that Poilievre pulled that in from 39,000. So I think, whether you like his politics or not, clearly his social media team, his marketing team, was able to get the message out and actually get people to register and sign up, which I think is pretty interesting. So I don't know what your guys' comments are. I'm kind of more curious with this objectively from a political standpoint, Keith.
Yeah. You know what I think is very interesting? Like, even now, Steve, when you were chatting, like you had to qualify everything in terms of, you don't want to, everyone's walking on eggshells these days. You don't want to hurt someone's feelings. So remember, guys, we're Canadians. You go in the corner, you keep your elbows up. I was chatting with a kid the other day. He's playing hockey. And I was chatting with him, and actually it was a young lady. And I said, "What is it, rough out there?" "Oh yeah, it's pretty rough." I said, "Listen, when you go in the corner, keep your elbow up, hey? That's how you keep the other kids away from you."
My God, that was the most Canadian thing that's ever been said on the podcast.
Well, you have to, right? You have to push around. But now these days with politics, my God, if you say something to be construed one way or the next. Anyway, so back to, I think, Westy, you're going to go into in a bit as well, and Rich, like we're headed down a pretty nasty road coming up here politically. But the interesting thing with Poilievre winning, one of my good friends is involved with the Conservative Party, has been for a long time, has done a lot of work for them and stuff like that. And, I was with her a couple of nights ago at a wedding, and it came, I think it was announced then that Poilievre won, and she wasn't happy with it. She was very displeased. And I say, and I figured out, of course, because all of the political establishment, they like the status quo. And it's my impression that he is not part of the political establishment. That's why they tried to wheel out Charest there, a few weeks back. And obviously, with the Liberal Party in power now, they have their political establishment. But you're going to see, the media guys coming out blazing, and even from within his own party, right? They won't be that supportive of him until they have to, because then they will, turn the cheers around the right direction. But I think, again, be Canadian, guys. Keep your elbows up every now and then. Don't be afraid. Rich,
Hey,
Rich has elbows to put up. He has sharp elbows.
Rich is wearing his NDP orange t-shirt
Oh,
today.
I was a fan of Jack Layton, but not the MDP. Go figure. I think it's really interesting because you mentioned it's going to be a nasty, I think, election cycle. I think it's only nasty because for the first time in, I would say, 5, almost 10 years, there's a viable opposition in Canada. There's a candidate who's young, actually bilingual, can speak to and speak about the issues that are pressing Canadians. Whether you agree on his prescription to fix that is irrelevant. He can and does, and eloquently so, speak to and about and directly to voters about issues that actually bug Canadians, not the ones that certain political parties are obsessed about. And so this idea that you have a viable opposition is why, the CBC is, turning the propaganda wheel faster and faster, that the Liberal parties are feeling a little bit of the heat, the squeaky bum time, as they say in the UK. And I actually also think that it's I think what I'm sort of watching is that because you have a viable opposition, which, by the way, I think is healthy is what you need in a democracy. You need a healthy, viable opposition to keep the party, especially in a parliamentary system, to keep the party in power, which is the problem here in the UK, for example. You have a terrible government in power, Liz Truss, and then you have a completely non-viable opposition in the Labour Party, and then that boat just waffles back and forth with no direction. So I think, and so this is, for me, that is the key takeaway. You have, for the first time in nearly a decade, you have a viable opposition. And what I'm looking for is the impact that will have on the Liberal policy over the next 2 years. And I can basically guarantee Twinkie bet on this is that the Liberal Party will pull itself to the quote unquote right. Because they know what they've done over the last 5 years, which is basically become the first NDP government in Canada. And I think it'll be really, really interesting to watch them basically turn that boat towards more market-based politics, talk about things like inflation, talk about reducing deficit. Remember, I think in Canada, the Liberal Party is a spectrum, just like most political parties. And it will be interesting to see how some of the more quote unquote right-wing Liberal caucus members see their voices get heard, see if they're put into the cabinet, if there's a cabinet reshuffle and those kinds of things. So that to me is the big takeaway.
Yeah. What I find most interesting, and this is why I've always said I really enjoy like finance, because I feel like at the end of the day, it's like people that are in finance, like, money managers, hedge funds, whatever, like you're forced to keep your emotions out of it. You basically have to dig for the truth. You have to figure out what the truth is, regardless of if that fits with your political views or your beliefs or your confirmation bias. You have to basically seek out the truth. And that's basically how you try to make money, off these trades. And so I always just find it, because I'm looking at all these, Twitter accounts, following Poilievre getting in there, and just the amount of people just like out of anger and just unobjectively, I think, so I'm looking at a lot of these like political analysts being like, oh, this guy still doesn't have a chance. It's basically over already. And it's like, and I feel like, I don't know, it's just weird. Like these guys, they got the PhD at the university, they're, and it's, to me, to sort of dismiss these numbers. Like, again, if Jagmeet Singh had gone out there and run a campaign and pulled in, a record number of donations, I'd be the first one standing up and say, man, his marketing team, somebody's doing something right on the marketing side, regardless of if you're voting for them or not. So that's kind of my opinion on this. Again, we're not going to stick too much into the politics here, but I do want to actually jump into some comments here, clip to some comments from Justin Trudeau just following the Poilievre announcement. Let's clip that in right here.
As you all know, the Conservative Party picked a new leader over the weekend. I want to congratulate Mr. Poilievre for becoming the leader of His Majesty's loyal opposition. Now, we've been making every effort to work with all parliamentarians, and we will continue to do so. But this doesn't mean that we're not going to be calling out highly questionable, reckless economic ideas. What Canadians need is responsible leadership. Buzzwords, dog whistles, and careless attacks don't add up to a plan for Canadians. Attacking the institutions, that make our society fair, safe, and free is not responsible leadership. Telling people they can opt out of inflation by investing their savings in volatile cryptocurrencies is not responsible leadership. By the way, anyone who followed that advice would have seen their life savings destroyed. Fighting against vaccines that saved millions of lives, that's not responsible leadership. Opposing the support and investments that have helped save jobs, businesses, and families during the pandemic, that's not responsible leadership.
So basically, I think what we're in for in this is going to be, I think for the first time in many, many years, Canadian politics is going to get exciting. It's going to be a heated debate. Again, regardless if you're on the Liberal side, if you're on the Conservative side, or what have you, I think we can all agree that these are going to make for some entertaining debates over the next several years, and probably an interesting upcoming election, which is technically slated for 2025. But correct me if I'm wrong. I believe that there can be what's the right terminology for it? I'm drawing a blank.
You got me.
I wasn't listening truthfully. So
you never listening. A vote of confidence.
Yeah, that's it. Well, no, the coalition in theory could break down, right?
Right.
It's actually called a non-confidence vote, not
non-confidence.
A vote of. Yeah. You're
non-confidence,
right? You're too in a different world all the time.
Old people.
No, but
so
I
here's
think
one thing to
Steve,
think about.
Oh, sorry. Go ahead.
Yeah. So after this, by the way, guys, we'll talk about religion. That's nothing to do with politics.
And then sex. Hooray.
Yay.
Boomer. He doesn't remember what that is.
But I'm not quite sure we'll actually, not say we, I mean the economy will make it that far. Again, I think the stage is set, guys, for some kind of a financial stressful event. I sent out on Twitter, I think it was yesterday, a couple charts just demonstrating what Canada's debt load was like on the two different metrics back when the last time we experienced stress. So back, you guys were playing PB hockey then, I think, back in 2001, 2, and 3, during those years. The Canadian dollar was headed to 50 cents. So I had clients then, they actually sold at the bottom. Like, that's how stressed they were. But, at the time we had a surging debt load, but we were the only ones in the world with really a challenge at that time. Everyone else was somewhat okay. But, the Canadians, we got saved because the commodity boom started. A lot of money started coming into Ottawa. Paul Martin, guy wearing the red shirt at the time, he paid down debt. And that was very unusual for that side of the, of the aisle, whatever, at that time, because as you're seeing now, like, there's increasingly, spend, borrow. So if we do experience a financial or economic crisis coming up, I don't think it really matters which color shirt is in power. I just don't think they're going to be able to, do a stick save. You get it? Hockey theme?
Oh, God.
Zinger.
Rich didn't play hockey growing up, by the way.
How dare you? Of course I did.
He kept his elbows
I got my
down.
passport. I didn't think I got my passport.
But that's something to think about. Okay, cool.
But yeah, I think at the end of the day, if you're going to ever have because I know a lot of people are saying, Poilievre, he's sort of feeding into this right-wing extremism, but I'm I think there's definitely a portion of that silent minority or whatever you call it. But I think that what's important here is that anytime you have inflation running at 40-year highs and the cost of living is going up and people are actually worse off economically, it brings out fiery politics, right? It brings out that breed. And I think that's where you get into these regime shifts where things start to change. You break down the existing system. You start to question, central banks and stuff like that. People that don't even know who Tiff Macklem is all of a sudden want to know why their mortgage is going up by thousands of dollars every month. This is what brings out regime shifts, right? When you get double-digit inflation in food prices, people start to get angry and people start to look for change. And so I think that's why ultimately this is a pretty big deal. But speaking of change, the Canadian labor market They had some data coming out last week. We've talked about this, how the economy we think is going to continue to trend lower and weaken. And that's really ultimately the goal and the objective of the Bank of Canada right now and of central bankers globally. So the Canadian labor market lost another 40,000 jobs last month. Employment has now declined 113,000 jobs over the past 3 consecutive months. And the unemployment rate for the first time in a while is up from 4.
So wait, so you guys always give me shit about not trusting the Canadian employment data, and now you're referencing
Well,
it.
it's working in our favor. It's confirming my confirmation bias, so I am announcing it publicly here. The unemployment rate is up from 4.9 to 5.4%. I now have full faith and confidence in Stats Canada. They are a fantastic enterprise.
Checkmate, I guess.
Keith, do you have any comments on the data?
No, I think, Rich made a good point because we joke about it before. It is pretty volatile. However, that it is a consistent trend. Like, it's not getting better or, volatile. It is coming down. So,
I pointed out more so because it's 3 consecutive months. Okay, let's put it that way. It's not a one-off, hey, this month. And we do see a lot of revisions. StatsCan is notoriously horrible. So let's put that out there.
Yeah, absolutely. And, again, like I always like to say, we wake up every morning, trying to figure out, has anything happened that should force us to change our view? And that was just yet another data point suggesting that, we are headed for slowdown. So the Bank of Canada, as well as the big banks and the media, they're saying it's going to be a soft landing. And if it's great, that's awesome, right? That's going to be really great for everyone. Because we mentioned last week, hey, if Canada does get a soft landing and, Steve's new favorite country goes down the toilet, Canadians will be able to buy a nice property over there in Italy. However, I think you're going to start seeing a turn soon where everyone will start talking about, we are increasingly, heading towards some kind of a hard landing, which is coming up. So that's the way I see the numbers.
There's just a little bit of a little more context I'd like to add to the Canadian employment rate. So not only is it trending down, despite your guys' misgivings on the data, I think that's a really good point, and that is a difference between what we all often talk about as the volatile release, is that in Canada that you just do not have the wage growth that you've had in the U.S., for example, and that's a function, of different things, weak productivity growth, maybe. Much more immigration in Canada than you have in the US in absolute terms, which is wild. You can only imagine what it is in relative terms. But, and then obviously the housing being a drag. And then, there's a bunch of other stuff too. But to me, that's the other wrinkle as far as, the expected retrenchment in spending. In the US, you have high interest rates, but their mortgages are not being affected by that increase in interest rate to anywhere near the degree you have in Canada. And in the US, you have much, much higher wage growth, in some cases 10, 12% for some sectors. And in Canada, the wage growth, those numbers are maybe 2 or 3. And so for me, that's the other wrinkle I think is important to highlight. So
let's add into this as well, because we actually had a big headline. I think everyone was kind of playing it up, and people are probably reading into this maybe a little bit more than they should. But again, this kind of all coincides with what we're talking about, right? Inflation, central bank policy, which is derived to slow demand, to basically make people less wealthy. So we had StatsCan. Thank you, StatsCan. Reporting Canadian household net worth dropped by nearly $1 trillion last quarter. So StatsCan reported combined net worth of $15 trillion in the Q2 2022, which was down 6.1% from a year ago. So they shed about $990 billion off Canadian household net worth. Which was predominantly related to obviously housing values declining. And that $990 billion decline was the single largest quarterly drop on record. So again, these higher interest rates are obviously starting to bite. And when the largest asset of Canadian households' balance sheet, which is housing, when that starts to decline in price, your household net worth, so to speak, declines. And so I think that is going to have larger ramifications here moving forward, which is, hey, all of a sudden, less housing values, less equity to tap into. You've got the wealth effect where, when your house is declining again, your largest asset's declining, your net worth is going down. You're probably not feeling as wealthy and going out and buying a whole bunch of extra goods again, which is all part of the central banker's plan, is to kill demand, to weaken balance sheets, so you stop spending and they can rein in inflation. Of course, the last part I will jump on the Canadian side of things is we actually had, and this is not just a Canada only phenomenon, it's really happening around the world, which is the government's mailing checks out to fight inflation, which I think really tells you everything you need to know about the current social and political environment today. But we did have the Trudeau government announcing, was it how many billions of dollars to fight inflation? Basically, it's a subsidy of a GST rebate, which we talked about in last week's show. A GST rebate, $500 checks to certain households to pay for their rent, which Scotiabank ironically came out this week and said that it was a horrible idea, and it was actually going to prompt the Bank of Canada to likely have to raise rates even further, because basically the central bank is working to obviously reduce inflation and kill demand, and these governments are actually coming out and going in the opposite direction by providing more subsidies. And we're not just seeing this in Canada, we're seeing this obviously all around the world.
Can I touch on just, sometimes we often say, oh, the central banks want this and central banks want that. And people who are listening might be like, well, how the hell do you know that? Well, I listened to Carolyn Rogers, who is the deputy bank of governor, central bank,
deputy bank of
Canada.
Deputy governor of the Bank of Canada.
Thank you.
Put that on your bingo card.
That deputy, and she, by the way, I listened to her speech, and frankly, I was really impressed. She was honest about inflation. She was honest about and forthright about the fact that services inflation is sticky and it'll take a long time. But the reason I'm bringing her up is because she literally said, and I quote now, "We need a period of slower growth." And so, sometimes we're quite flippant about these, comments about central bank, but that was on September 8th. You're welcome to go and verify and double check me. But and to her credit, I thought it was a great speech. It was short, it was sweet, it was erudite, it was to the point. And the key takeaways were it's going to take a long time for inflation to come down. They're going to front load the interest rate hikes, and more importantly, is we need a period of slower growth. And so that's an important, just to give back you up a little bit, Steve, just because I know sometimes we're fast and loose with a lot of these comments, but this is the state of play, sadly.
Brilliant. Keith, you have any comments? Your house values have gone down. How do you feel?
I'm poorer than I think.
Well, we've also got, some inflation data out of the U.S., which is extremely, extremely important. That basically seems to be the one data release that everybody seems to be watching with bated breath. And so, maybe Rich, I'll let you sort of break down the inflation print from the U.S. this week, and then Keith, you can kind of jump in on the market side of that.
So I'll go really quick. So the market rallied basically in the hopes that that inflation would come in and disappoint. It did the opposite, but I think it's a mixed picture, right? So you had a headline came off. I can't remember the exact number. I actually, for some reason, didn't write in my notes, on the back of energy, which we know energy is starting to come off. But the thing is, the reality is the things that I sort of look at are the underlying components. So core went up. And why did it go up? It went up because of the shelter component. Now, we've talked a lot about shelter, owner equivalent rent. I'm sure we've made a meal of all the definitions, et cetera. But the key thing is that the shelter component continues to ratchet higher. Remember, shelter is, between 39 and 42%. Someone will correct me. And it just that component continues to ratchet higher, and that pushes up the core bit. But also the other thing is food. That went up a lot. So we're at 11.4 in the US on food. And then the two other last bits before I'll pass it on to Keith, which is there's ways that you can measure sort of the breadth or stickiness of a particular inflation. And so one of them is from the Cleveland Federal Reserve, and it's called the median CPI, where basically, they line up all the different components they look at, 50, 100, I can't remember exactly how many it is. And they take the inflation rate for that median item. And that sort of tells you that the breadth or the depth of the inflation, and that continues to rise. And so then you also, although the headline number came down because obviously energy and a couple other points, that to me is, I think, why the market got, I don't know why the market got freaked out, but that's to me, the key bit is that you still have an incredible amount of sort of upward momentum in that CPI print in the inflation story. And then finally, it's the and then that relates to the last point, which is the services inflation, which again is much, much stickier, related to labor market, and will continue to push up core. And ultimately, I think, and hopefully maybe Keith will, I don't know, it'll be interesting to hear what you have to say, Keith. I think it's just that there's not enough rate hikes priced in, and that sort of, in my view, led to what the market did, which is absolutely freak the F out. I don't know, Keith, do you have anything to add?
Yeah, so just to reset everything, I think it was a couple of weeks ago at the Jackson Hole Fed meetings they had. Remember Powell came out, the 6-minute speech, and he said, hey, I'm going to raise rates a lot longer than you guys think. We're going to keep doing it until inflation actually comes down to our target. And markets sold off hard after that. And since then, it's been a bit choppy here going on. But this week we started with a rally in equities, and it was clearly short covering, because you could see the biggest movers in equities were the ones with the high short interest. So that's how we can tell, it is short covering. So coming into this number, everyone was expecting inflation to be, it's still high, but to be slowing. Okay. So the rate of change is slowing, and therefore
second derivative.
Yeah, the second. Rich, we have about 45 minutes to kill. Do you want to explain how that works? Align it with the diffusion index.
Sorry, keep going.
Okay. However, so everyone's expecting this. The markets are all lined up. The numbers coming out at 8:30 Eastern, and everyone's ready for a party. It's going to surge. And so the key point to know with the two main data points is the month over month and the year over year. And markets look at core. So it doesn't matter why, but they do. They strip out food and energy, which doesn't make sense. But the core number for month over month and year over year, not only was it greater than what analysts were expecting, it was actually higher than the previous month. So this was a really hawkish number, and it gives the Federal Reserve even more, I guess, ammunition or power incentive to keep raising rates. And I guess we say next, there she was gone. Markets just my terminal was just on vertical lines going down on every single market. So which was bad. Dollar. Except for King Dollar. So talking our book here, we had about 35% of our portfolio was up around 1.5% that day. That's just the way that we were positioned for something like this. And and now it's, markets, they still haven't sorted themselves out. It was a really weak rally yesterday, which, today's Thursday, of course. So yesterday, the day after the CPI number. But, it's increasingly looking like, from our perspective, that, equities could get softer here going even into October. But I want to talk about one other thing. If you guys want to, it's different than inflation. But if you guys want to go back to
before you go, I one thing.
My point is a lot more interesting than your
No, it's definitely not. I think you forgot to mention that the bonds also just continue to sell off. So it's not just equities. And I think that we can talk about the correlation later, but that's also, I think, more interesting than what you were going to say, Keith.
Yeah,
so go for it.
Finally, Rich says something interesting. We should get a T-shirt. Rich every now and then says an interesting thing. But Rich is right. Short bonds sold off, and as well as the long end of the curve. It was pretty bad. But I want to jump over to Europe next, and nothing tongue in cheek about it. But really, the one data point we should all be watching for right now, and this is for Canadians, because you always say, what can cause Canadian markets to roll over? And, we consistently say it could be an external event. So that's why we always stressed everyone, be global. Like look around the world, what's happening. So right now, the biggest number that all the guys that I hang out with online, because I never leave my neighborhood, is it's the Italian 10-year bond yield. So it's now at 4%. I put a chart up. I think it was yesterday. I think on the Twitter, and we're now at this critical point where the ECB, they absolutely have to support this 4% line. It is a hard line in the sand. So you think about it. Here's the ECB now, like they're raising rates because inflation is coming in strong. Meanwhile, Italy is, even though things are very beautiful on the ground in Italy, like financially, they're not good. Like they're just not good. But if the Italian 10-year starts surging higher with terms of yield, so the price is coming down, it's going to be pretty tough. And then, so here's what we got going on. So we have, rates are rising, bond and equity markets, they're being stressed, not only just in Europe, but around the world. Euro currency, it's stressed, like it's knocking around like the buck area, the par area, but it doesn't look great. And then you look at, the most powerful country in Europe is Germany. So when was the last time, guys, Germany had a severe recession?
Depends how you define it, but 2014 probably.
Yeah, that's not really a big one. We're talking about like the Queen Mum days, guys. Like you're back in like in the 20s and after World War II. Like Germany has been like this powerhouse. And because we all have short memories, really in the last 20 years, Germany hasn't, like it's never struggled, right? No. It's always been Southern Europe, which has done the struggling, which has always benefited, the Germans and the other Northern European countries. But so right now, the chancellor, he's saying, he claims, don't be worried, guys, be happy. Our economy is strong. Meanwhile, you have DIW, which is one of the think tanks over there. I don't know what DIW stands for, but they're telling everyone that we should expect a long downturn in the German economy. The other, the Germany Association of Towns and Municipalities, they're coming out and they're basically saying, guys, we're in for a real struggle here coming up. So again, it's the deck is stacked against Germany right now, which means it's stacked even more against the rest of Europe. So, I'm just saying,
it's not just the think tanks. It's not just the think tanks. It's if you look at the consumer confidence, the business confidence. So the IFO, which I can never remember what that, but it's basically the corollary to the ISM. It's one of the most important sort of,
IFO stands for information.
No, that's a terrible joke.
Yeah, I don't know.
But their business confidence is basically lower than it was in the height of the pandemic. And then if you look at DG ECFIN, which is Director General of Economic and Financial Research, is again another sort of not quasi-governmental organization that does all kinds of inflation expectations, consumer confidence, business confidence indicators. Have all collapsed. We talked about this weeks and weeks ago, so it's just sort of corroborating what you said, Keith, and definitely contradicting what the government is trying to tell you. But the funny thing is what they're now discussing is relaxing some of the rules on the spending, and we'll see how they, and that they might relax some rules on subsidizing certain industries. I mean, never let a crisis go to waste or something. Oh, I screwed that up.
Yeah. Never let a good crisis go to waste.
Yeah, exactly. So it'll be interesting how Germany reacts.
If Germany does roll over really hard, it's over for Europe. I mean, that's the bottom line. That's what it is. So
it's over for the currency. I think it brings Europe together, but maybe that's a conversation for a different day.
Yeah, I think Europe, as soon as things get tough in Europe, they all splinter apart into 19 countries for Eurozone and all that.
I think it was worse in 2014. It was worse in 2014. This is an acute energy crisis with a clear path to exit. And if tomorrow they turned on all their nukes and started burning coal, which they already have, and lowered the natural gas prices, this is to me an own goal that's easily rectified, which is start burning more fossil fuels and deal with your energy prices properly. it's not the same as 2014. I don't agree with that, but maybe that's a
Hey,
conversation
Steve,
for a different day.
Steve, what do they call it? When you get really too close to something and you can't see the big picture. I think Rich is way too close to the economic fantasy
Wow.
land called Europe.
Speaking of German energy issues, so Germany is edging closer to the nationalization of alien gas importer Uniper. Uniper, I think that's how you say it. Anyways, they've the government so far to date has already pumped a $19 billion bailout of Uniper. They've already taken a 30%, I believe it's a 30% stake already. So they're now looking to take a controlling stake of this German utility company, which is the largest in Germany. So yeah, there's definitely a lot of issues over there. As Rich said, it's definitely an own goal. But so we'll see what happens. I know Keith's predictions on the Eurozone continue to be a donut. So,
but it's not just the Italian spreads that I think we should keep an eye on. Just for people playing along at home, I think you should keep an eye on the corporate bond spreads. I think are also way too sanguine for what's going on, whether it's in the U.S. or in Europe. If you look at corporate bond spreads in Europe, they're high, but they're nowhere near stress levels, which I find kind of crazy, Keith. Because even if let's assume you're right and Europe is totally screwed and has no hope, then how are corporate spreads so tight right now? I find that bizarre.
Well, the European corporate bond market it's non-existent. It's basically the pension.
I think there's no volume.
As soon as something is issued, the pension funds automatically buy it.
Okay.
So it's not a. It's just a fantasy market. That's what it is. One observation from Steve. Wait, Steve. Did you just, before Rich commented, then did you use the term own goal? Is that what you just said?
it was an own goal. That's what Rich said. I agree with Rich.
It's where you going with this European soccer and stuff, man. It's hockey. Elbows up today.
Elbows up.
You guys got to come back to the motherland. Get back here.
Well, we're coming. I'm coming. December 1st.
That's gonna be a good time.
First in Toronto, plug. But speaking of yields as well, right? So we've got more happening in the U.S. as well. So an update in the U.S. here, we had the 30-year fixed mortgage in the U.S. hit 6% for the first time since 2008, which is essentially double what it was a year ago. Refinancing demand fell another 4% for the week and was 83% lower than the same week 1 year ago. Basically, mortgage purchase applications were 29% lower than the same time last year. So yeah, U.S. housing demand obviously continues to weaken. This is really just the story globally, which is at these levels of interest, a lot of things just start to break down. And so it's not just obviously Canadian housing, it's not just what's happening in Italy, it is happening globally. So I think that's an important thing to know. We're actually just waiting for an update on the national housing figures in Canada. We should have those potentially shortly here later this episode, waiting for the official release from the Canadian Real Estate Association. But I think that's kind of the ongoing trend here. And it sounds like, do we have an update, Keith, on the overnight rate? I think the BOC, for example, I think post Powell and post inflation there, I think the BOC added another 25 basis points. Your markets are pricing another 25. So we got, I think BOC is supposed to get to 4% by year end. And I think the Fed's at 4 now as well, right?
I need a second here.
Well, while Keith gets into that, I just want to. So I think I have a contrarian view on the U.S. housing, and I think worth sharing and walking people through why I think what I think. So I think that the U.S. housing is going to be bifurcated. People who own homes and have homes, I don't think that we're going to have the price declines year on year that I'm seeing these models on Twitter and people calling for disaster 40%.
Oh yeah, I think it's ridiculous too.
I think that that's just a gross misunderstanding of how sort of the reality of the U.S. home ownership. Number one is that debt to GDP in the U.S. is 70%. Debt servicing costs are really, really low. Mortgage servicing costs are even lower. And so when you see these numbers, I think it's fair to say that there's somebody in the housing market that's going to get absolutely killed. And it's going to be the home construction, and anything related to sort of the purchase and churn of that housing market. But whether or not you're going to have the systemic issues or having homeowners feel acute pain, I don't agree with that. All of the mortgage, not all, but an incredible amount of mortgages were issued when mortgage rates were at 3. And the corollary to watching that mortgage application index, which is sort of an index that calculates new mortgages, refinancing, smushes them together, and then compares them over time. And that number is very, very, very low, meaning that although if you were to go out now and buy a home, yes, you would be paying a mortgage rate of 6%. But the big difference between the US and Canada is when you get a mortgage in the US, it's a 30-year fixed product. So when you look at that chart, and we'll share it on YouTube, you can see the incredible amount of applications when mortgage rates were basically at, let's say, all-time lows or whatever. And so, in a sense, this is actually an absolute boon for homeowners. You have more or less an inflation protected asset. You're not levered, or nowhere near as levered as you are historically. Vacancy rates are also really interesting. Those are at lows for both rental and home ownership rates. And you have no forced selling. So unlike in the 2008 crisis where people had massive negative equity, there's none of that in the US. And there's none of this ratchet. So there's no arm sales. I remember in The Big Short where, you had a couple of years of a really low interest rate and then you had to ratchet higher. There's none of that shenanigans. And so, so you have, in order to have this massive rollover in the US housing price, you need to not only have a forced seller, you need to have, people you need to have excess supply, which there isn't, and then the other thing is, I think people sort of can do a little bit of math, especially in aggregate. It's difficult to say these kinds of things, but, inflation keeps going higher and higher. And, I think people understand that they need to live in their home, but their home is more or less an inflation protected asset. And so that's why, I really push back on the fact that house prices are going to fall 25, 40%. I mean, I've seen crazy numbers. Now, on the other side of that, I think if you build homes, if you're in home construction, I think if you sell products that go into new homes, white goods, I think that there'll definitely be some effect there. There's something that we look at for supply when it comes to home ownership. It's something called months supply. Steve, I'm sure you know about this.
Months of supply, months of inventory.
Yeah, for existing inventory, it's 3 months of supply, which is slightly higher than it was a couple months ago, but in aggregate and historically very, very, very low. But for new homes, we're back to 2008 peaks. So if you're a home builder, I think you're going to get it in the teeth. I think if you're a homeowner, frankly, I don't think you'll feel it. But anyway, sorry, Keith, you were going to tell us about oh, sorry, go ahead.
Yeah, no, I was just going to say, because you've got, I think it was a fantastic trade if you're a U.S. homeowner, 12 months, locking a 3-year term at 3%. And then, with inflation, it's peaked now, but hitting 9%, you locked in 30-year money at 3%. The problem is it's a different story. I think Rich, I totally agree. I think these projections in the US, I think, are ridiculous. I think the vulnerability is in these other markets like Canada, New Zealand. Right. I think Australia is the same, where you have these shorter duration loans, right? Like your loan resets every 5 years. You're now at the mercy of the market, right? So it's, or 2 years, or we have, I think, we talked about it in Canada, right? During the depths of the pandemic over the last 12 to 18 months, over 50% of the market has been going with a variable rate mortgage, right? So there's a lot of rate sensitivity, and you've got household balance sheets in Canada are significantly worse than most of the G20, and particularly the US, right? The US went through a very, very painful deleveraging in 2008 and 2009, and we didn't have that here in Canada. So I think when people start looking at what the Fed's doing, what the Bank of Canada is going to do, and whatnot, I think there's a lot more vulnerabilities in Canada than there are in the US.
So this sort of ties in with the expectations for the Bank of Canada. So right now we're at 3.25%. There are 2 meetings left for this year. There's one October 26th, and then the first week of December. So the estimate right now, where the market is pricing in 50 basis points for the next meeting, and then 25 at year end. So we're going to go from 3.25 to 4 by year end. And then that's it. There she was, gone. That's it.
There she was. Go on.
Keith, can I ask you a question? Do you think in the US there's enough priced into the market? Because I was looking at this the other day and I saw the terminal rate sort of at the end of next year. So December 2023, I saw something like 3.9. So, where we already basically baked into the cake another percent on September 20th. That's not a Twinkie bet. I'm just, throwing that out there.
Are you you on 100 basis points
for the Fed next week?
Yeah.
Yeah. I guess I am
So
making a Twinkie bet. But I'm just curious about Keith's point. I'm just curious about Keith's view on do you think there's just nowhere near enough priced in for next year? Or do you?
Again, you just have to go with one thing I love about the Fed. They try to be very transparent. And if the market is pricing it differently, they'll say, "Oh, guys, you got this wrong. This is what we're telling you." And if they don't tell you directly, they'll tell one of the Wall Street banks, and then they'll tell you. That's what they have. But for next week, it's a live meeting, and what we mean by that is that there is definitely a rate hike coming, and the market is not fully convinced what it's going to be. Right now, it's leaning more towards 75 basis points, but there is a chance it's 100. So Rich suggesting it's going to be 100. That's an outlier suggestion by Rich right now at this point. But for rates should peak at year end at 4.25 right now. So really you're asking, hey, is that reasonable? Will they go more or less? I suspect they'll be stopped by that time. I think. So it's really in line with the Bank of Canada. You think about it, like all the central banks, forget about what level they're at. It's really where they're going and where they priced to end. So, but unless we get, stickier inflation data coming out, they'll keep going. But the main point with the Fed, and we touched on it earlier, I know we brought it up, a few months back, and they, back then we were saying, hey, they literally want to crush the economy to solve the inflation story. And a lot of people back then said, no, that's not true. That's not what they want to do. But because of the way inflation is being created today, that's really the only solution they have. And, maybe we'll start seeing weaker economic data coming out now for Q3. We got 2 weeks left, so we'll start seeing some. If economic data doesn't start to roll over, then yeah, the Fed can, maybe they hike a bit more. But they want to see negative growth numbers. Isn't that weird? In our world, we call it negative growth. It doesn't make sense.
But that's what's so interesting about sort of the ISM. Remember, we've talked about this before, the Institute of Supply Management. They do a survey of thousands and thousands of companies. It's very reputable. It's timely. It goes back ages. One of the surveys they do is services. And when it's above 50.
What does that 50 number mean?
I'm going to be positive now.
What kind of index is that, Rich? What kind of index?
It's a diffusion index. But the thing is we can be negative all we want, but we have to be agnostic in the sense that that's why when I was, I look at thousands of charts, and that services ISM. Remember, I know the manufacturing data, gets a lot of credit and it's not as positive, but it's a much smaller portion of the economy than services. And that services indicator actually ticked up last month. And so it'll be something to keep an eye on. Again, back to Keith's point, if we get some positive data, we keep getting positive data on the employment front. If we get positive data on the ISM services front, who knows what's going to happen to those interest rates? They'll just keep ratcheting higher and higher, to Keith's point, until something breaks. But if the US, if the US sneezes, then the rest of the world dies of a heart attack or something. I mean, it'll be interesting how that all plays out.
I think we look at the rest of the world, right? So we've already chatted about Europe, which I think everybody's well aware. They're going in, they're arguably already in a recession. People are calling for a deeper recession. The outlook is pretty negative there. I mean, we haven't talked too much about China this episode, but I mean, hey, China real estate is the single largest asset class in the world. And so as that starts rolling over, which it is, I mean, I think it has to create a deflationary impulse around the world.
Well, the CCP this week, I think they researched all their banks to see who had exposure to, I forget what the company was, pretty big global player. But again, when that's a public announcement to say, hey, the government is calling all the banks to say, hey, do you have exposure to these guys? Because they're so big, there are knock-on effects. So if one big guy can't pay the bills, it automatically means the next guy down is not going to get paid and stuff like that. So the potential for a debt crisis, well, it already is a debt crisis in China, but it doesn't look like it's getting better yet. So you want to see that stabilized, and then that will help the rest of the world.
Yeah,
That's
so
why
the
it's
I-
so crazy that. Oh,
sorry. One of those ports, one of the Chinese ports just got. Is it closed? What's happening over there? Oh no, sorry. I think there was a typhoon headed towards the port. This is not a major story for now. Sorry about that.
I was just going to say the IEA, the International Energy Agency, says, quote, this week, we are seeing the biggest drop in China oil demand in over 3 decades. And of course, as Rich pointed out, they've locked down, I believe, another major city there, another COVID.
Well, no, it's a small
lockdown.
city. It's a small city of 21 million people, which is like, I don't even remember the
half
name
of
of it.
Canada.
But this is something we got to keep an eye on for the next like couple months, because I think it's what do they call it? It's like every 5 years or whatever, they reelect they don't reelect is the wrong word. They rubber stamp the next leader of the Communist Party. And I think it's
a 5-year
October.
plan. They come up with a 5-year plan.
So it'll be interesting to see how like that trifecta. You have COVID continues because, they still haven't vaccinated enough people because they wanted to use their own vaccine. It wasn't as effective, blah, blah, blah. And they continue to lock down tiny cities of 21 million people. And then you have the real estate crash / debt crisis. And then you have, on top of that, you have a leader of the CCP who's making a power grab. Remember, they're having 3 terms as the leader of the Communist Party and the leader of China is not unprecedented, but it is rare. And I can't remember I should know this off the top of my head, but I don't remember the last time it happened. It hasn't happened in like 30 years or whatever. I can't remember who it is, and so he's going for a power grab. And Xi Jinping is going for a power grab. And so those 3 kind of, those are the 3 little telltales will be interesting to like keep an eye on over the next, it's September now. We'll see by the end of November. I think all that stuff will be sort of taken care of in one way or another.
These guys are just going to keep lying. I remember I was actually arguing with a very nice gentleman on Twitter, but he was like very, very much advocating that China was the model to follow for the pandemic, that like we should just go into these hard lockdowns until like there's no cases. And he was like genuinely felt that way. And says, I wonder if these people still feel that way today. But it's just horrible, man. I had a client actually recently relocated from China back. He's originally born here, and he told me he was supposed to be here months ago, but it took him. His travel was delayed by a couple months because he just kept getting locked down and couldn't get out of the country. So yeah, I feel for the people over there because it's got to be tough to live with.
Yeah.
Thank God we got Trudeau. Oops. I'm just kidding. I love you. I love all red, white, blue.
Don't forget Rich's orange.
Rich's orange shirt.
I like Jack Layton. He got it, man. He would have been a good.
I've actually, full disclosure, I will say this on air. I've actually voted for every political party in Canada.
There you go.
So there you go. That's a fun fact.
We're ending where we started, I think, right?
Full circle. What are we talking about religion? Let's get into it now. A lot of beautiful churches here in Italy.
Oh, come on. That's amazing.
Yeah, it is pretty cool.
Let's square it back. Next week is number 50, right?
Oh, that's right.
Loonie Hour.
Yeah. I think we're going to do something for 50 or 52 because 52 would be the official 1 year
anniversary.
So it's been a hell of a ride. We still are lagging
Arrive Can
in the reviews. So if you guys could please get up on the Apple Podcast and Spotify, get us a 5-star review, help us continue to push past Arrive Can. It is desperately needed.
We also pump one more. Should we pump our event?
Yes, the event in Toronto, December 1st. By the way, if anyone's in Toronto that lives there and has some leads on some good venues, like we're looking for something pretty down to earth, pretty chill, similar to our last one in Vancouver. We're not looking for like a stuffy, formal, hotel ballroom where people have to come in suits and stuff. We want it to be a pretty cool environment. So if you've got any leads in that in Toronto, please send us an email. It's pretty easy to get a hold of us. We are looking for the actual venue, but the date is in fact confirmed. It will be on Thursday, December the 1st. So if you are planning a trip to Toronto or want to start booking plane tickets, what have you, that will be the date. That is confirmed.
Cool. I'm looking forward to it. Maybe we can go to a hockey
final
game.
Parting words.
Maybe we should have it at Maple Leaf Gardens. I like that place.
At least there'll be a couple winners there, right?
Maybe.
And still no national housing figure data. So I will wrap it up there. That's a conversation for next week. Anyways, rates are up. Market still sucks. That's all you guys need to know. Thanks for tuning in. As always, we appreciate your support and we'll see you next week.